Hey, very good afternoon to you traders. Mark here from Day Trading Room. I want to talk a little bit about a specific setup in stocks that's been throwing opportunities for the past several weeks. How to trade those large gap ups or large gaps down in stocks specifically. Other markets does happen in, but because of the gap risk of stocks, you get this opportunity a little bit more. First of all, just want to give a credit to traders in the room from last week. Fantastic trades. In particular, one guy who was waiting for his short opportunity through the last few hours of the trading day. Got his tape entry, lovely entry in the 1920, I believe, something like that on the YM 5719, 5720. And his discipline was just rock solid, ironclad discipline. He said he was going to hold it until the close, regardless, either a stop out or a hold till close, and that's exactly what he did. Brilliant to see that sort of discipline. Brilliant to see that sort of trade, patience, and it sort of sums up the week. Really, it was a great end to a great week. In particular, being patient, waiting for your opportunities, waiting for your setups, because there are plenty there, and that just really proved it. So let's just move on to some of these specific stock setups. Now, a couple of examples I'm going to throw up. When you've got a big gap up or big gap down, I don't like to chase. I hate chasing markets. It's ultimately a losing strategy over time. There are very few circumstances where you can chase, but really, if you want to keep yourself on the right side of things, waiting for a retracement or some sort of signal to get in with your bias is a far better way of doing it, in my opinion. So first of all, you set your bias. If there's gap up, you want to see if the gap holds. You want to see how it's behaving after the first hour or so of trade. In this case, Under Armour gapped up 20 something percent, drove aggressively. I'm actually not sure whether the gap was 20%, but anyway, drove aggressively and it was at 20 something percent up at one point. It's ticking your boxes. The gap up, it's at 52-week highs as well on the daily chart. There's a 10% short float on the stock. It's gapping up well and truly above highs as well, so it's a very significant move. And so you start adding up arguments for the bull side, the bull case. Ticking your boxes, tick, 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 tick. And it's okay. Now I want to look for a good entry in this. How can I look for a good entry? For me, it's always about the pullback. It's always about the pullback. Same when trading the YM. Always looking for the stall, the pullback, the buying on red, even if the past five candles have been green, you're looking for that little red retracement to buy into as opposed to chasing on the green. So this is the sort of thing we've got here. This is an example of it. We pushed up, we pulled back, we held the 103, obviously between 102 and 104, held the 103 here, started to roll back up, came down, tested it again, couldn't get below 103, then starts to cement itself as support. So you can start to work your trade off that level. Now whether you decide to take it on the second test and scale some out into the high, however many tests later in the day, even the next day when we closed up at 105, at 20 something percent up from the prior day's close, and then the following day we just open up with a gap down to that previous support level. It's giving you something to work off. Regardless of how you trade it, it's all about positioning yourself, having an idea or a theme for the trade. In this case, a long for a further push to highs, because you've got all the evidence that that's what's going to happen. But if it doesn't happen, the important thing is you've got to have a point to get out. The risk. Where's the risk on the trade? At what point is the trade negated? And you can quite easily have a stop at any point under that 103 and say, listen, if the market goes into that place, I don't want to be involved in it. It's not the premise is not holding true, and I'm out. And just think how different that is from when you chase something. How far does it pull back? The strongest market in the world can push up. You chase it, you could sit through quite a reasonable pullback, and it can move on another, twice that initial move quite happily after pulling back. And then if you're trading short term, you're stuck in this, you're taking heat, you still think you're right, but how far do you let it go, and at what point do you cut it? So it's all about trying to manage that. Let's look at another quick example. This is from a couple of weeks before. On Netflix on a slightly higher time frame, 15-minute chart, same type of thing. It gapped up during earnings. Come on, chart, let's go. It gapped up during earnings, after earnings, should I say. The Thursday and Friday were very weak days. It held firm. The following Monday, it pushed lower. You got then the wick to work off. So you're looking to find, a position to work off. Then it closed the day pretty much where it opened after forming a wick. It's ticking the boxes. It's gapped up on the Thursday. It's held on the Thursday, held on the Friday throughout carnage in the markets. Monday, tried to push lower, failed. Then you can say, okay, admittedly it's a wide stop if you're going to trade it at the close, but even if you trade it on the first pullback, it's probably an acceptable stop for a 3-day drive, thinking you're going to take out some highs, maybe targeting the 400 price point. Same sort of thing. You're ticking the boxes. You've got a bias. You've got a trade idea, and then you're just looking for a trigger point to quantify the risk. Another one on Facebook. Thursday, the gap up. Started to hold the 61 level. Drove lower. Found some support there, wicked underneath it, held it, pushed the highs, couldn't go any further, but it closed the day with the gap up intact, in between the range, not at lows, not at highs specifically. It was just holding, and everyone was happy. So the following day, when it opens up below that level and immediately drives back into it, then you're starting again to tick all your boxes. You're starting to create a trigger, you're starting to create a level to work off to quantify the risk. 61's your support. It holds after the gap lower, holds, then continues to chug into the drive mode. So, and a couple of guys in the room got on the end of that Facebook trade, which was great. But that's the same sort of idea, the large gap. There was a couple on UK stocks actually as well to the downside, same sort of thing, gap lower, held at lows, and the next day you've got some levels to work off. So rather than just chasing, if you chase this Facebook gap at the open at 62, you're sitting there as it unwinds to 60.53, very unpleasant, very difficult to position, to adjust your position to suit that. Whereas if you wait for the market to unfold a little bit, wait for it to confirm some levels, put some levels out there on the short term so you can work off, it becomes easier to quantify the risk, becomes easier to take the trade. So something I'm going to look for next week, specifically in stocks, scanning for those gaps, whether it's on earnings or news or whatever. Futures continue to offer plenty of opportunity, loads of setups there. It's really, as I said earlier, it's all about being patient and waiting for your trade. There are plenty of opportunities, but being patient and waiting for the one that fits your criteria, is the key to really getting on the end of one. So keep the risk managed, traders, and I'll be back with another video later in the week. Take care.